Hey, good afternoon, everyone. Thank you, Mani, for having me again. I'll just quickly run through some of these slides. This is our house view of S&P Global. IHS Market, where I used to work, was acquired by S&P Global earlier this year. So part of S&P Global now. Just the normal disclaimer. Oops, why am I getting this at the... Okay, perfect. Sorry. I think the key thing for us is, and all of us have been warning about the upcoming, or rather the impending Chinese slowdown for years now. I think it's finally here, whether it's Chinese zero COVID policy or the housing market. But the fact is, we are looking at a subpar growth for the Chinese economy for several years to come. If we go back 2020, Chinese economy grew around 8.1%. Our expectations for this year is around 3.8. Late last year, we were expecting around 5.1. With every passing quarter, we have been downgrading our forecast. So it will be good to get around 3.8%. That's our current forecast, but I won't be surprised if we are downgrading it further as the months pass by. Two key points here. We have the Chinese dynamic COVID zero policy, but what's also happening under is the housing market. It won't be wrong to call the housing market in China in a deep recession right now. If you look at the new sales, if you look at the new starts which are happening right now, the new property sales, everything signals to us that we are in a deep recession in the housing market. And despite some of these stimulus measures which have come through, they haven't been directed towards the housing market as yet. There has been some industrial stimulus measures. There have been few for the consumers, few for the smaller enterprises as well. But overall, the economy as of now looks to us for the remainder of the year in a pretty bad shape. When I say pretty bad shape, we have to look at the context where Chinese economy used to grow. We're talking about 7-8% for the last decade or so, even higher in certain cases. Our view for this year is 3.8. We are expecting a bit of a recovery of 4.9% in 2023, but that was at the start of the year somewhere close to around 5.86%. So with every passing quarter, we are downgrading it further. One thing which I wanted to add here, and I was speaking to some people outside, is there has been a market expectations that after October October of this year, there would be relaxations in the Chinese COVID zero policy. That is not our view. Our view is this goes on till March 2023 at least, right? So that's a different view than what the market expectation is, at least for the shipping market. I've heard about everything goes back to normal, everything opens up after October 2022. Our view is unlikely. We are going to see this protracted dynamic COVID zero policy all the way until March 2023 at least. If you look at this, again, going back into the latest numbers which came out, the housing starts, the industrial production, if you look at the year-to-date fixed asset investments, the key tenets of the economy are all slowing down. The target was over 5% at the start of the year. We're down to 3.8. That takes away around 1.7 percentage point from the GDP growth. Industrial indicators as well, whether you look at the PMI, whether you look at the fixed asset investment, the steel PMIs, the flash PMI composite, as well as the underlying components, all have been slowing down. And this is before the global economy slows down to our expectation, what's happening particularly in the US, as well as the EU, which is already in a recession. The key components here, if you look at the second chart, is the housing market. That saw a 7% contraction in Q2. That's the key driver for shipping, as we all know, it's always been. And that's something which we are essentially worried about. Like I said earlier, if you look at these localized COVID lockdowns which keep on coming, right? I think over the last few days, again with Beijing, I think what's happening with the People Congress, Party Congress, and then again March 2023, these will continue to happen. So I'm just trying to water down a bit of the expectation or the optimism of October 2022 goes away and everything comes back to normal. Our view is it isn't. If you look at the number of cases, from where we are looking at externally, they seem pretty low. But for China, where the immunization, the vaccination has been different from the global economies in terms of their approach to COVID, it's a very specific policy which China has taken, and unlikely that that goes away anytime soon. Again, I think this is something to highlight here. We're all part of the export-import industry in that sense. The exports have just started slowing down. August numbers were a surprise to the market, but that is before the global economic slowdown comes, right? We can start seeing it in the economy in terms of imports as well that have been slow. but the expectations of what we saw, double-digit growth in exports, so that's given away now. I think next year we won't be surprised if exports start contracting. The US economy, particularly the West, is struggling right now. The consumer has started rolling over. So China faces external headwinds, particularly in terms of exports. So our view is as exports slow down due to the external headwinds, the imports as well, because of the industrial slowdown in China as well as the housing market, will trend lower. So the overall external factors, macro conditions for China at this point of time are negative in the short term. That's not the right, as in that's not the wrong word to say if we say they are negative in the short term. And I'll show you what we're expecting in terms of the longer term outlook, right? So we are, as in terms of our house view is, after a period of 20 years of super growth, China has started what we are calling a long-term deceleration in the economy. When we say long-term deceleration, I'm talking about economic growth. We are unlikely to see those 7-8%, barring something external happens or massive stimulus comes in, which we do not expect. We would start seeing China slow down, and if you look at some of those numbers, we are maybe looking at I think this will sound slightly bearish, but we are closer to 2 to 3% over the next decade or so, towards the later half of the decade, right? And that's a significant slowdown for consumer, for the shipping demand in that sense, right? So headwinds, like I said, include high corporate debt. The Chinese economy is still very, very highly leveraged, and they've been working. So what we are seeing right now happening in the housing market is by design, right? They are deleveraging, but that includes some pain, and which we are seeing right now. There is also a problem of demographics, as you might have seen. Some of that is there's a 20% unemployment rate for China at the moment in terms of youth, as well as China is rapidly aging as well. So to create that demand, they have to come up with some stimulus. They have to, and we'll talk about that when I sit with Gregory. But for us, China continues to grow, but just that the economic growth, which we've been used to over the last 20 years, is unlikely to return at any time soon. Having said that, just the last chart here is we're looking at the 10 years growth. Asia Pac still is the major contributor to global growth. China will still be 33% contribution. We have US around 14 and India around 8.3%. But the overall global economic growth itself is going into a subpar growth for the next decade, right? So the contribution is still pretty strong for China, but the overall growth continues to slow down. With that, I'll just sit down.
Hi, Rahul. Thanks for the informative presentation. So I think generally the picture we have painted is that the market has slowed down, and also I think we have seen constantly that there is a readjustment of forecasts for China on an ongoing basis. Can you share with us perhaps the immediate effects by reference to the shipping industry?
Definitely. I think China has been the real driver of global shipping industry, right? Ever since China joined WTO back in early 2000, we've seen whether it's the dry bulk demand, whether it's the tanker demand, whether it's the container shipping demand. In terms of commodities, China is still the biggest importer of crude oil, soybeans, iron ore, coal, and so on. But that is all looking in the past, right? What we are expecting is all of that starts plateauing. When we say plateauing, is we're talking in terms of growth. If you look at this year as well, last year has been pretty good for dry bulk shipping, but if you look at this year as well, going into this year, the market expectations were very, very high. People were looking at the Chinese slowdown in the housing market, but they're expecting there will be another stimulus which will come. I think we've all been so accustomed to China coming out with stimulus with every 2-3 years that we go back to 2008. And I might be repeating again myself. I was back in Lehman Brothers back in 2008, and we know how China essentially saved the world. It wasn't the Fed, but the shipping industry was saved by the Chinese $1 trillion stimulus, right? Again, we saw that in 2012, 14, 18, even after 2020, we saw some of that. But the stimulus which they're putting right now is changing. That's not essentially what the shipping market requires, right? The stimulus which we see may be a bit on the industrial side, but also consumers. China has been trying to pivot the economy towards consumption for quite some time. It hasn't happened. But coming back to your question in that sense, I think for the dry bulk shipping, we are seeing demand plateauing. We are expecting around 2 to 3% average growth for the next several years, right? Container shipping is essentially, and I remember last year when we were here, we said, myself and Arjun were on the panel, and we said sell containers. So I think container shipping is now going to, the party is over for that. I think that's been not a surprise with the way the spot rates have fallen. But China is facing external headwinds. The export markets for China are slowing down.
They're going into a deeper crisis in terms of the economic growth. Started with EU, we're getting into the US as well with Fed raising interest rates. We would see a consumer slowdown of a very significant pace over the next several quarters, right? And then China also has these partners, the trade partners, still a very important trade partners for most of the world economies, right? As China slows down, that will also have an impact. So I don't want to paint a very negative view. I know it sounds negative, but the fact is, what we've been used to over the last 12, 15 years, we have to narrow or rather tone down our expectations for the shipping market in terms of demand. There will be bouts of volatility when the rates spike, positioning and all that play into the market. But overall, the Chinese slowdown will have an impact on every shipping market. I think another example there is, and when we look at deeper, is if you look at the congestion, I think the Chinese congestion basically topped off late last year. There is no congestion at the moment, and that shows you in the industrial side of the economy, the smaller segments, wine and bulks, they've been slowing down as well. That's the real picture of the economy, not the bigger segments, which are essentially iron ore. But we are seeing congestion, essentially no congestion in China at this point of time, except for the last few weeks where we've seen some because of the hurricane and the weather events.
Okay, thank you very much, Rahul. So I think we have a sort of a slowdown of imports and exports in China as a result of perhaps the COVID policy and things that's happening around the world. Are there still opportunities for, I guess, businesses in this context?
Yeah, definitely. I think shipping, this is again, we've all debated this at this very stage over the last few years, is an industrial industry, as in it's an industrial side of the shipping business which will continue to benefit. Right? I think the speculative nature of shipping, which has played over the last 10, 12 years, and maybe more so after the 2008 financial crisis, goes away, right? So the bigger becomes stronger with what we are seeing, particularly with decarbonization, particularly the cost of supply chain going up. The opportunities would be there for the industrial shipping companies, right? We're not saying China stops growing. It's just that if you look at the base of a $15 trillion economy growing at 3 or 4%, that still leads to a demand, and that still requires all these services in terms of shipping. So there will be opportunities for the industrial players. It will become difficult, or the barriers of entry in a slowing industry for newer entrants. That will be a challenge. We would expect the current incumbents to get stronger, which we are seeing certainly on the container side. We'll see that and we started seeing that bit on the tanker side as well with consolidation. We probably might see that on the dry bulk shipping. There would be opportunities, but I think the key here is there is no other China. I think this has been always talked about, that India is the next China, or for that matter, this country becomes the next China, but there is no other China. We are still very heavily reliant on China.
Okay, thanks, Rahul. So even with a negative Chinese growth forecast, are there any upside risks available?
So when we speak to our economists, I think our house view is China is still not a fully liberalized economy, right? It's still a closed market in certain cases. So there is opportunities for China to fully liberalize its economy, open up the market, and that presents a new set of opportunities for everyone in the market, right? So I think they are looking at that, and if this slowdown deepens, rather than a stimulus, we would expect the Chinese market to open up. But the policy signals over the last 18 to 24 months have been on the contrary. China is actually closing down rather than opening up to the world, right? So I think it's a very mixed picture in that sense, but that would be the key one for us, is capital convertibility, opening of the economy, opening of the markets to external players. Maybe a good example is, I know it's not shipping, but let's say the US tech companies or the other tech companies going into China. But they've also taken a stab at their tech companies as well, right? So I think it's a very mixed picture in that sense, but the bigger theme would be if China opens up further liberalizes its economy.
Okay, so I guess the key question here is whether or not when will we ever return to a 7 to 8% GDP growth?
Yeah, we would all love China to go back to 7 to 8%, but that's not how. As you saw there, by 2028, 2030, we were actually down to 2%. I think China is a fully matured economy by that time. I think they still have, as in the urbanization, all those factors which have played will continue to play, but they will be at a much, much slower pace than we've all been used to. So our expectations of China coming back to 7, 8%, even double-digit growth, which it saw for many, many years, is very, very unlikely. So it continues to slow down. It's just that this is a soft landing for China, right? What we're seeing is from 7, 8% in the last decade, early high double digits, and then this decade, an average 4 to 5% growth at the best. So this is soft landing, this is good, and this is what we should pray for, rather than a hard crash in the Chinese property market.
Okay, so I think generally we are saying that we will see improvement maybe commencing March 2023. So from now till then, what do you think will be the impact of this policy on, countries beyond China around the world?
I think that's an important question. Why we are saying March 2023 is this is what our economist teams, our people in China, like I said, we have a big team, thousands of people working in China who are actually looking at this macro side of it. Our global chief economist and everyone, when they see this, it's not October 2022. Their expectation is this goes on for the next 6 months, right? And March 2023 is again something which we've said because there is a big handover or in terms of party congress, which is, I actually forgot what is it called, but the transition actually gets confirmed in March 2023, right? I think the whole third term for President Xi, right? So March 2023 is what our expectation is. They start relaxing a bit. I think good indication is Hong Kong has started opening up now, so that gives you a bit of indication. We were also looking at President Xi traveling. This was the first time he traveled after 2 years, I think since COVID began, so that also sends a signal that they're moving in that direction. But again, then you see what happens with lockdowns in some of the biggest cities. You're talking about millions of people there, Hebei and few others, where it was locked down for less than 1,000 cases. So our view is it will be a slow process, slow approach to this. And what this means for the world is, if it was happening at the time when the world economy was on a much stronger footing, then you would have all those supply chain crises again, ports clogged up, congestion, all of that, right? Now that the external headwinds are there and the global demand is already slowing down since start of the year, it's not being felt. So now today with the lockdowns, we don't hear stories about China COVID's lockdowns, congestion at the ports, or for that matter, supply chains being clogged up. It was the external demand coupled with what was happening in China, what was driving it. External demand has died up. It's quickly rolling over, right? So that's something which is not impacting the external markets in that sense. But it is negative for the trade partners which are sending goods, right? If you look at the Korean exports, Hong Kong exports, the Korean chip maker today said they haven't been this worried since decades, right? So all of that is signaling to us the Chinese slowdown is deepening.
Okay, so I think overall there's some, I guess, positive that might come out from it, but overall it's a slower growth for the next few years. So I think as a concluding thought, do you have any concluding insights that you would like to share with us, and whether, what are your short-term
I don't want to be a party pooper here, but I think the most important thing for the shipping industry, and we've been highlighting this, is the supply side. That hasn't looked better in the last 10 years, the last 15 years, but that's also a function of what the market is signaling in terms of the global demand, what's happening in terms of particularly with the whole decarbonization, what fuels do you choose, right? So the supply side will support earnings. My view, as which I've said over the last 2 years, is shipping this decade will make more money than what it did last 10 years. You'll cover your cost of capital, you make some extra money on top of that as well, you'll have shareholder returns. But I think to every time expect that, and this was again a question at the start of the year when market expectations was, at least on the Cape size, we'll go back to 80,000 again. That has fallen flat. We might go and it might be proven wrong in the upcoming winter, but if you take out the coal flows which have changed, if you take out all the rerouting which has happened, the market would have been even weaker. Right? So I think people are underestimating the Chinese slowdown, and that's what we are trying to say here.
Okay, thank you very much, Rahul. I think
Thanks,
that those are my
Gregory.
questions. Yeah, thank you.